Hi there, everyone, and welcome to this edition of On Track. I'm recording this on the 30th of September. I'm recording it from Melbourne, in rainy Melbourne, just down here for a week to catch up with a few people and may go to a couple of the Spring Carnival racing meetings. It's been an interesting month. I'm going to dive into some concepts. There's a lot of activity at our investment committee meeting. I'll talk about some of the things we've done shortly. But firstly, as always, if I can get the clicker going, this is a general advice warning. That just means this is designed for clients of McGregor Wealth Management, particularly those that use our care portfolios. If you're not a client, please feel free to listen to this, but do seek advice before acting on anything we talk about. What I'm going to cover today is the news, put it into context. We've had an Australian budget come out. I'll talk a little bit about that, talk about what's happening with property shares, but I want to also have a couple of themes today around the Aussie dollar, what's happening, and also mortgage rates. And I thought I'd put up a timeless quote from Warren Buffett here, which is, be fearful when others are greedy and greedy when others are fearful. It's certainly a time where there's a lot of fear about. And as Warren would say, that's usually the best time to be a strong investor. That means either buying or sticking with your long-term investments. In terms of some of the news, as we look through the rates on the right-hand side here, the RBA has continued to increase the cash rate, 2.6%, so it's risen rapidly. Over the last couple of months, the predictions from the bank economists range from that ending at anywhere between 3.1 and 3.6%. I think it might end up being in between there. We think it'll probably go up a couple more, then pause over Christmas when the RBA doesn't meet, and hopefully we'll see some inflation dropping numbers that will hopefully see us at the peak of the rate increases. I'll talk about where rates are in the broader context shortly, but you'll see government bond rates at about 4% in Australia as we speak, 90-day bank bills at 3%, getting back into the normal zone. The Aussie dollar dropped down about 64 cents against the US dollar. We did hit about 62, and I'm going to talk about that a fair bit. The inflation number came out for the last quarter at 7.1%. It was higher than the previous quarter, but this was expected by both the market and the RBA, so no surprise. And the budget papers have the inflation rate peaking at around the 7.1 to 7.3 level, and then starting to drop throughout late 23, 24. And we kind of think that's a fair assumption, although obviously there's always room for that to not be so accurate. Mortgage rates are going up as the cash rate goes up. So, the cheapest mortgage rate you can get out there at the moment is in the low 4s. The variable rates are in the mid 5s, so highly worthwhile shopping around. If you need some help with that, yell out. We've got some great mortgage brokers we work with who at the moment are helping us get the lowest possible rates for our clients. Anyone with $1 million mortgage, 1% is $10,000 a year. If you can save on that, that's a lot you can put into super or just have available for life in general. We've seen obviously the Australian budget come out. We saw the shortest Prime Minister in the UK's history in tenure term with Liz Truss come and go. And we've seen the new UK Prime Minister installed, both the youngest and the richest ever, and a new Chancellor, that's the equivalent of our Treasurer. And they've announced some policies which have seen the market in the UK steady after its blowout with the announcement from the previous Prime Minister of what they were going to do economically. And that came about because what they want to do was try and expand the economy at a time where the Reserve Bank in the UK was trying to slow it to battle inflation. So it was a message for all governments around the world that if you go in conflict with your Federal Reserve, Reserve Bank, etc., you're going to cause them chaos in the markets. And that was the backdrop that the Australian budget was presented with, where Jim Chalmers presented what was widely considered a fairly responsible budget, which they needed to do. They kept saying, we've got to fight inflation first, which is, most people kind of agree on. It's a little bit painful in the short term, but it will provide for a healthy economy and base for markets in the long run. And we're seeing some inputs into inflation falling, and particularly commodity prices. You'll see the chart on the bottom with the pink line here shows in the commodity prices. This is the RBA's index of commodity prices falling, and what I've shown down here is the Aussie dollar also dropping down to about 62 cents at one stage, down around its historical lows. I'll talk more about that and what impact. And one of the other notes we're seeing is that China is still locking down, and Xi Jinping gets another 5-year term, or coming up to that, and they will continue the backdrop of instability. We think with China, but it's just a fact of where we are in the world right now. So moving on. So in terms of what's happening in the world, no real changes here. I'll just highlight the usual. The world is still growing, so we're not in a recession globally, except for Russia. The US growth is slowing and potentially heading towards a recession. I'll touch briefly on that again today. Inflation rates, the middle column there with my 2 red circles. You see the US number at 8.2, the Aussie number at 7.3. It's high across the board. So all the world is obsessed with trying to get that down so we don't have a repeat of the 70s and 80s inflation. And I think they'll get that right. It's just how long that's going to take, and we will see. The good news is we're starting that with the unemployment rate in Australia at a low of 3.5%. So even a slowdown will not put us into crazy unemployment levels, you would think. As budget repair is a hot topic, Australia, the little green smiley face down the bottom right there, shows that Australia has a debt to GDP ratio of 36%, which is effectively the lowest out of all those top countries around the world. We see the US at 137%, Japan at 266%. So Australia goes into this little economic, I won't call it a crisis, but it's more an adjustment period. Goes into this crisis in a pretty good shape. As always, we are often the lucky country. Portfolio returns, for the year that's ending the 30th September, returns for high growth down about 10%, and we're seeing Aussie shares down potentially more than that. International shares down a bit less than that because of the Aussie dollar falling in parallel. I'll talk a bit more about that. And we're seeing, the 7-year returns are still sitting on what we would expect, slightly below, which the returns we use to plan your long-term financial plan or the portfolios around. But it hasn't been a great year, but that's it's the price we pay for having equities in the long run. The behavioral bias for this month, it's a twin bias of what we call loss aversion and endowment effect. And loss aversion, it's just the tendency for people to prefer avoiding losses than obtaining gains. It's irrational. We're scared of losses 3 times more than we are of the equivalent gain, which does not make rational sense, but that's because we're emotional creatures. Closely related to this is the endowment effect, which effectively means we're more attached to something we've got than on something we don't have. I see this with a lot of my clients with life insurance. As they get into their 50s, life insurance gets more expensive. And as we start to talk about cutting insurance, they tend to be attached to it, to the point where I said, well, if you didn't have any insurance right now and we are recommending some, you probably wouldn't take it. But because you've got it, you want to keep holding it. So there's that, and that's okay, but it's not a rational thing. And investing, these things can cause us to make bad decisions. So what we tend to do there is not do things when we're scared of loss. And that can often occur in times like we've got at the moment when markets are down. and we tend to hang on to things that maybe we shouldn't hang on to just because we've got them. So just for awareness, as always, we are emotional creatures trying to operate rationally, which doesn't augur well for our investments, and that's why that behavior gap is so prevalent over time. Where are we at the moment? Well, we're down from the top of the market, nearly 15%. This is, as I've reminded us in the last 4 to 5 months here, just a normal downturn. We've had 6 of these, 6 downturns of more than 12% since the GFC in 2008-9, where the market did drop 50%. So this is kind of a normal representation of the share market. It's up steadily over that last 20 years, but it's gone through its typical stages of boom bust and lots of wall of worry, and we're quite clearly in the wall of worry at the moment. But as always, this too shall pass. Some interesting numbers I found as I was getting ready for this on global GDP growth rates. And I want to make a point here that growth rates, that's the rate of growth, are quite volatile. So the top left hand there, you'll see the growth rates varying from positive 6-7% to minus 5%. And that top left chart shows the growth rates as predicted by the International Monetary Fund. So there's actual rates. You'll see the red line is emerging markets. And emerging market and developing economies grow higher than established economies. We expect that. That's where we like having emerging market shares in the portfolio, even though they're more volatile in the short term. That's why we keep it to a relatively small amount. But advanced economies grow the slowest, and you'll see the yellow line in the middle, which is the world growth. And the average rate there for the last 10 years and going forward, just over 3% for the world. And at the moment, for 2023, that's still predicted to grow 2.7% in spite of all the talk about recessions, etc. Right down the bottom in the middle is the actual world GDP. So it's a much steadier number, and you'll see how it goes up and down. How it goes up constantly over time, but you'll see the rate at which it goes up varies, and that's the growth rates. So just be aware of that difference in the number. We saw that used a lot when China was growing at 7%, and as it slowed, the headlines would read slowdown in China, but what they actually should have been saying was a slowdown in the growth rate. When it started to grow at only 5% instead of 7%, it was still growing, but there was a slowdown in the rate. But the headlines would say China slowdown, making it sound like it was actually slowing down. That's the headlines at the moment. We're seeing a slowdown in growth rates. So don't misread that as growth slowing. GDP slowing. It's still growing, just not as quickly. As I pointed out last month, and I'll do this just to emphasize again, recessions are often a great time to be buying into the share market if indeed we are in a recession. We probably aren't in Australia. We probably are in a very mild one in the US. But when I note my choice of words there carefully, we're in a recession. We're not going into a recession in terms of the US, and extremely mild, as pointed out in that previous slide. So you can see the recessions in 2020 and 2009, not much effect on the actual ongoing march, which is the increase in global GDP, which is the backdrop for share markets continuing to do well. Now, my main feature I want to talk about in this month is the Aussie dollar. So down the bottom, you'll see the Aussie dollar, and on the right-hand side, you'll see the scale. The Aussie dollar at its peak, about $1. And we all remember this from trips to overseas. When we travel to Hawaii or the US and the Aussie dollar's high, life is good, and we get more US dollars to spend. When we travel, like we are at the moment, when the Aussie dollar's low, around 60 cents, it costs us a lot more in US dollars. But we don't often think about the effect this has on investments. And if we go back and we look at from the period 2002 to 2011, the Aussie dollar rose from close to 50 cents all the way through to $1.10. Now, this has an impact of slowing down the returns we get from overseas shares. It's the flip side of, when we get to buy more US dollars when we go traveling, we get a lesser return on US shares. when the Aussie dollar gets strong. And you'll see my big red circle. Now in this chart, it shows the best performing asset class of each year going back to 2001. The orange boxes are Australian shares, Australian equities, and you can see from 2003 through to 2007, extremely strong, all the way through to 2009, really, except for the 2008 crash. And that was because commodity prices were going up. Commodity prices often drive the Australian share market into its booms, and that's because we export a lot of commodities, think iron ore, gold, and many more. But the important point for this month's discussion is note how Aussie shares returned far more than global shares. So all the little red dots here. So in 2003, Aussie shares 14%, global shares 0. In 2004, Aussie shares 28, global shares 10. 2005, Aussie shares 22, global 16, and so on. So in every case there, except for where the Aussie dollar crashed in 2008, and it was reversed, all of a sudden Aussie shares minus 38%, global shares only minus 24. So 2 points. When the Aussie dollar rises, the returns we get from US shares are less than they would otherwise be. And it's important to note that during all those years, investors in the US, say, were getting good returns as well. But for us, we got lesser returns. Now, the flip side is also the same. So we've then had a decline from 2011 right through to 2020 and still in that low point. Now, what that means is as US shares have dropped, particularly say in let's look at 2000 and so let's have a look at the period from 2013 to 2015. So the Aussie dollar dropped 14%, 8%, 10% in those years. And all of a sudden, global equities perform better than Australian equities. So up 49% in the 2013 year compared to Australian market, 20%. In 2014, up 15%, when the Aussie market was 5%. In 2013, up 11%, while the Aussie market only up 2%. So in the last 10 years, and you'll see this when I go through the performance numbers, the drop in the Aussie dollar from $1 down to around 70 cents has meant that anything we own overseas, we've got an extra third on. So in this case, it's been over the last 10 years, 15% return we've got on particularly US shares, while investors in the US in exactly the same investments have only had a return of 10%. So we've got 15% versus their 10% because of that. But if the Aussie dollar goes on a reverse of that, we may see the opposite, a bit more like the period of 2003 through to 2009 with the Aussie dollar climbing. Now, we're not predicting that the Aussie dollar is going to go all the way to $1, although at some stage it probably will, particularly if commodity prices run hot for a sustained period of time. What we are saying is the Aussie dollar is very cheap at the moment, and that's caused by the US dollar being strong against all currencies around the world. As whenever we're in a crisis, this is what tends to happen. So some measures we've taken with the portfolio this month is to increase our hedging on our offshore assets, particularly our US shares. And that was done by a few changes, both in the active portfolio, but also in the core portfolios. So what we're effectively doing is locking in some of our overseas investments at today's low prices of the Aussie dollar. So it's the exact similarity, but opposite of us saying whenever the Aussie dollar's at $1, we'll buy lots of Aussie dollars ready for our holidays. The reverse is true in investing. So whenever the Aussie dollar gets close to 60 cents, it's a good idea to lock in some numbers for when it inevitably goes back up again and the US dollar falls back again. So we've done that this month. It's not a speculative move. It's a long-term move, not dissimilar to when interest rates were dropping and we didn't want to play in the long-term bond market until it was back to kind of normal, one that proved very successful for us. And we think and would expect that this over the next 1 to 4 years will give us an above average return for the international shares that we hold compared to those that aren't hedging. A little bit complex, I know. Hopefully that makes sense. Happy to talk to people and happy to talk more about this in the next few episodes if there's some interest. And let's keep going here. And I'll just get the mouse working again. And sorry, the technical glitch. My mouse has gone to sleep. Apologies, not sure what's happening here. Here we go. Apologies there. Recording in a hotel room in Melbourne, not at my normal boardroom. Let's have a look at 10-year bond and the yield curve across the top. So fairly steady in the last month. So the blue line is the current one, the green line is the previous one. Fairly steady. 6 months ago is the orange line, where as we know, we've got higher interest rates. I want to put this in perspective this month by looking at the bottom chart, which is the last 25 years of 10-year bond rates. So Australia on the left, and we're back now to where we were from about 2012 through to 2014. We actually think, as inflation peaks, we'll probably stay in this zone of about 3 to 4% as the new normal. But obviously if inflation was to persist, that may go higher. The bond markets are continuing to tell us they don't think inflation will persist. Same story in the US. They're back to about 2008 kind of rates. Once again, the bond market is saying that long-term rate is going to be steady around 4. I think between 3 and 4% would be a reasonable expectation, or 3.5 to 4% going forward. But once again, these things are hard to predict. Into context, as I mentioned about, the market just does go through this psychological pattern of boom-bust wall of worry. We're quite clearly in the wall of worry at the moment. At the moment, we still rate the market as fair value, potentially just a little under that, but we're just very keen, like the Reserve Bank and other watchers at the moment, to see what happens to inflation and interest rate numbers over the next little while. And if they come out reasonable, the market is probably cheap at the moment, but we think it's fair value at either way. Just emphasizing some of our mess it up factors this month. And there's so many going at the moment. The negative media, I've talked about that lots and lots. But the short-term focus, we tend to pick out a single issue at the moment. It's inflation, and we get obsessed by it. In the long run, if you look at that bottom right-hand chart, the share market continues its long-term march, and even the short-term fluctuations, will wash through. And the other thing is timing and selection. The people that think they can time markets, nobody actually can. And it's particularly prevalent in down markets where people think, I just should get out of the market and wait till things get better. And the problem with that is when things get better, the market will be 20, 30% higher, and they'll have missed out on that recovery. So just emphasizing those this month. I won't go through, but all of this, but our care philosophy continues to make sure our clients never have to sell good assets at a bad time, particularly the reserves portfolio, which is so important during these downturns. Let's have a look at all the individual sectors. Aussie shares, down 7.94% for the year to the end of September. Got a little bit worse that in early October, but you can see in the top right-hand chart, we're recovering nicely as we speak at the moment. So the numbers are a bit better for October. Hopefully that'll be sustained through for the rest of the year, and we'll get some positivity back. Long term, when you look at the bottom right, the value of 10,000 invested 10 years ago would be around 25,000. So even though we've had that short-term volatility, long-term, a great place to be invested. US shares even better. And as I said, they've been averaging over 10 years about 16%. However, if you were in the US, that would be pretty much the same as our Aussie shares at 10%. That's why we think markets are back to kind of fair value, because that's the normal long-term return. But look at the difference that falling Aussie dollar has contributed with that higher US share return. So in the previous slide, we had $10,000 growing to 25. The US shares, $10,000 growing to 50,000. So twice as much for return of 15% compared to 10%. But 5 to 6% of that return was purely from the fall in the Aussie dollar over this 10-year period, from around $1 to around 60 cents. So that's why we've taken some steps to lock in some of the low Aussie dollar in our portfolios, so that as US shares start to recover after this significant downturn they've had, that we will get the full benefit of that, and not just the trimmed benefit that results when the Aussie dollar goes up at the same time as the US share market goes up. US small caps, same story, long-term return about 15%, 1 year -9, also 10,000 to about 46,000. Great place to invest. Also a free kick for us Aussies, with the Aussie dollar dropping from $1 to 60 cents over that period of time, so dropping 40%. And we, once again, that's why we've locked in some of these changes. Same with the global leaders. This is the top 100 companies in the world. You'll see the stocks there: Apple, Microsoft, Amazon, Google, as well as Johnson & Johnson, Exxon Mobil, JP Morgan Chase, Procter & Gamble, Nestle. They're pretty much the biggest 10 companies in the world that you own through this stock. Once again, 10,000 growing to 36,000, a significant amount of that through the rise in the US dollar. About 60% of this portfolio, the global leaders, is US based, the rest being the rest of the world. Emerging markets, not so good over the last 10 years, 5%. But as I talked about earlier, with long-term growth rates in emerging markets superior to developed markets, this will come back. But obviously, China issues, Russia issues, and other things have kept this back. Still a stellar return, $10,000 growing to about 18,000 over that period. Gold, the insurance in the portfolio, very solid for the year at 6.46%. Over 10 years, only 3.7%. Gold is in the portfolio as insurance and a currency hedge. It's done that job very well. We have made a slight change. You'll see in your active portfolios that we've moved some of the gold to be hedged, and we may continue to do that if rates stay low, which gives us an opportunity once again to lock in the Aussie dollar at low rates, which is good for all our offshore investments. What's happening in property? And before I do that, just the context of the property market, that we've got here, where we know it goes up over time, but it goes through sort of periods of not much growth for a long period of time, rapid growth, slight recovery, no growth for long periods of time, followed by rapid growth. We're definitely in that slowdown phase, and I'll share with you some figures in a minute that show property prices are pretty steady at the moment. They've stopped dropping. That total drop is fairly modest, and we'll see how that plays out in the coming months and year. The property clock, which is the other thing that we use, and if we look at that, so property clock basically says that property prices from the bottom go through an upturn to the top of the market, then a downturn. And they go through as we get undersupply, falling interest rates. And if you think back to the last 2 years, falling interest rates drove that upturn. Then we get lots of turnover. And at the top of the market, you start to get lots of construction. And that's where we start to see a peak as we get oversupply, falling rental yields, although rental yields have held steady in this cycle. And then we get rising interest rates, and that certainly led to the downturn and lower sales. And that's where we're at the moment. And I'll show you some numbers around that. But I thought I'd look at one of the key drivers of property prices, which is population. And these numbers are also from the budget papers from the budget last week. And it shows this, if we go from the top left chart here, with the population dropping during COVID because we stopped bringing people into the country. And then the forecast so the top chart is a growth rate chart. So it shows the Australian population growing between 1 and 1.5%, not a very big number, but it does translate to population growth of about 300,000 a year over time. And you'll see that comes from two sources: net overseas migration, which is adding the green line, about 200,000 people a year to the population in normal times, but during COVID, it dropped off. So we had no net overseas migration. So actually had population stay steady, which obviously means there's no demand for extra property. But as we start to come back from this, and we're already seeing it coming back way quicker than expected. So we're very quickly getting back to the normal. I think we're about 60% of the way back, where we'll have 200 to 230,000 of net migration, which means 200,000 people coming into the country each year. Natural increase is steady at about 100,000 people. Put that together, about 300,000 new people in the country each year, or about 1% increase in the population. Those 300,000 people have to live somewhere, so that will continue to put a floor on the property prices. And down the bottom right is where that's growing state by state. And you'll see Queensland, for instance, has a growth rate of about 1.3 to 1.4%. Victoria, 1.8 to 1.9. So it's higher because the natural pattern for immigration is people immigrate. They often will go to Victoria first, and then we get net migration within Australia that kind of heads to Queensland and to WA. So WA 1.3%, so solid as well. Tassie not growing quite as quick. Northern Territory not growing quite as quick. And South Australia not growing quite as quick. But certainly New South Wales, everything else above 1%. So yeah, interesting population coming back. Good news for the property market. In the budget, Chalmers also announced a target of 1 million new homes. And it's interesting reading the politics into all this stuff, but critics have sort of said, 1 million new homes is not much. That's what we've developed in each of the last 5 years. But it is important to recognise that that was in a period of low interest rates, where construction came through to match the price increases. In the previous decade, construction new houses was about 771,000 over that period. So a target of 1 million is reasonably ambitious. It's not crazy, but it will. Obviously, the more houses you build, the more downward pressure that puts on prices. So we've got immigration coming in, and if we maintain that, we should achieve an equilibrium, which leads me to my conclusion that we're just going to see slow and steady in the property market for a few years. In the long run, as always, it will do well, but the next few years will probably be fairly placid in terms of growth. What are we seeing in the prices? So this is the October numbers for the month, and Sydney and Melbourne actually were flat to slightly positive. So we can read into this that the downturn that we've seen in Sydney and Melbourne has pretty much stopped. The annual rates are pretty steady. Top to bottom nationally, I think we've seen the market fall about 5%, very much a minor correction and very much to be expected after the stellar gains that we had in the couple of years leading up to that. Units the same, but units are actually growing stronger in terms of the monthly figures. And I would put that down to the increase in immigration leading to more demand for units, particularly in places like Melbourne. But the other thing to note there is Adelaide, Perth and Brisbane still pretty strong, and they're our preferred sort of investment property locations for people at the moment. But as always, get advice, yell out. We'll work with anyone wanting to buy an investment property on the ideal spot and timing of that and structure of the loans. A note from CoreLogic down the bottom that the housing market has reacted strongly to the rate tightening cycle, with the national index down around 6% since its peak in May last year, and that meant sales volumes have dropped around 11%. For anyone selling at the moment, you can feel that in the market. It's taking longer to sell. And the value of new housing finance has dropped 14% over that period of time. And that's quite simple. Supply and demand, interest rates up, leads to less demand for property. Here's that picture of interest rates. And on the left, we've got the variable rates that have gone from record lifetime lows of down around 3% back up to around 5%, slightly higher for interest only and investment loans. And then the fixed year rates down to 2%. seen a couple of clients who managed to lock in 1.9%, about a year ago, but now fixed rates are up 5% for 1 year rates, more like 5.5 for 2, for 3 year rates, about 6. My view, and it's just a view, is you can probably avoid fixing rates right now unless you really believed we will go into 10% sort of thing, which we certainly don't. And you can see right on the edge of that chart that the rise in the rates has started to drop or steady. And if interest rates go through the pattern we expect, we'll probably see these pull back to more normal rates that will probably be in the zone about where they are now. Let's call it 4.5 to 5% for interest rates, which is back to where we were, 2017 through to 2019, that we thought were pretty low then. The obvious implication, though, the increase in rates is hurting people's budget. They got used to all that money that they had extra to spend. So that'll result in a bit of a pullback, which will result in the slowdown that we're experiencing. It'll be interesting to see how that plays out. In the national property clock, not much change there. Sydney's pushed a bit lower into a declining market, but most of the markets around Australia are either the peak or slow decline. Still some rising markets, interestingly. Perth, obviously one of those, as we've talked about. Alice Springs, wouldn't be buying in lots of these places. Our preference, as always, is growth capital cities in a 2-hour circle from there. But it's interesting to see where the market's at. Units more in the rising market, less in the falling, but the same sort of pattern. And they're now saying places like, so the changes in blue there, Adelaide peaking, Southern Highlands declining, Fraser Coast actually getting higher, Hervey Bay. All very interesting. So just summing up, thank you for your time as always. But our core fundamental belief that all investing is best done as part of a real plan that's based on your goals and your specific plan and who and what's important to you. We design the portfolio for one purpose, to suit your long-term plan. We take a long-term view, includes all the boring stuff and diversification, asset allocation, and liquidity. And we use low-cost index funds for most of the portfolio, except where we need some very specific non-index stuff. Projecting against the short-term volatility through the reserves for our retired clients, through dollar cost averaging, for our clients that are still adding to their investments, and rebalance regularly. You'll see some rebalancing transactions in the portfolio this month where we're topping up the emerging markets and trimming a few other things. As always, I point out and leave you with the only 3 ways to lose money, which is panic and sell, have to sell, and not properly diversified. We make sure you don't do any of those things so that we can enjoy the long-term benefit of rising markets, both shares and property. I'll leave you with that. I hope you have a great month and look forward to talking to you. As always, Rob McGregor signing off.